We'll get started in just a moment. I'm seeing participants enter the room right now. So just give them one more minute and then we'll get started. Okay, everybody, let's get started. My name is Jessica Kennedy, and I'm an Assistant Director of Alumni Engagement here at Rowan University. And I'd just like to take this opportunity to say welcome. This is our first ever homecoming at home. We are very, very excited to have you all with us today and to hear from one of our favorite alums, Mr. Edelman, class of 1980. We're very excited to have you all here today. Before I do get started, I do want to go over a few housekeeping items for the group. So the first would be, you've heard me say it if you've already been logged on, if you could just take a moment to mute yourself. That is in the bottom of your WebEx screen. We will be having an opportunity later on after Mr. Edelman presents to have you ask questions. At that point, we're going to be asking you to submit them via the chat, which you are able to do at any point beginning now. We'll monitor the chat, and then we're going to call on several individuals to be able to ask their questions directly to Mr. Edelman. So at that point, our staff and team that's working real hard behind the scenes is going to unmute and mute your microphones at that point. So just be aware, listen for your name if you did submit a question. We are also going to be raffling off a few fun prizes at the end of the event. We have 4 copies of Mr. Edelman's most recent book and 2 copies of a book he wrote with Mrs. Edelman, also a Rowan Proud alumnus. So we are going to be giving those out at the end of the event, so make sure you stay for the entirety. Again, please make sure if you have questions to submit them via the chat. I will be monitoring what comes through and we will be calling upon you. At this point, I would be very honored to pass the baton on to Dean Tweedy, who is the Dean of the Ric Edelman College of Communication and Creative Arts.
Thank you, Jeff, and welcome everyone. We're glad to have you here today. So you probably all know Rick as founder of Edelman Financial Engines, America's largest independent financial planning and investment firm. As a result of his successes, among his other accolades, Rick has been ranked by Barron's 3 times as the nation's #1 independent financial advisor, and he was recently named the Barron's Financial Advisor Hall of Fame. Rowan University is rightly proud of Rick and Jean, his wife, as Jessica mentioned, who began their career at what was, at the time, Glassboro State College. Rick was a member of the then Department of Communications, and he continues to draw on that education he received in all aspects of his career. As a New York Times best-selling author of 10 books on personal finance, as the award-winning host of one of the longest-running radio shows on personal finance, as a producer of award-winning specials for public television, and as a sought-after speaker. And Rick and Jean are educators with an emphasis on improving financial literacy across the globe. They are also tremendous supporters of Rowan University, among their many philanthropic efforts, including support of the Jean and Ric Edelman Fossil Park and the Planetarium. More recently, Rick and Jean committed $10 million to the students of our College of Communication and Creative Arts, the largest single endowed gift dedicated solely to student scholarships at Rowan University. And our college is proud to now bear the name of Ric Edelman. Thus, it gives me great pleasure to introduce our first speaker for Homecoming at Home, Mr. Ric Edelman.
Well, thank you very much, Sandy. I appreciate that. You all obviously have nothing better to do. So thanks for taking the time to spend an hour with me today. When we were talking about putting this together, the big question we had was, what do I talk about? And what I decided is that I'm going to spend very little amount of time talking to you and instead spend most of my time talking with you in a dialogue. So I'm just going to offer you a couple of opening comments for just a few minutes, and then the bulk of this hour will be your Q&A. So I figure you know what you care about much more than I do. You know what is of interest and concern to you. So you'll have an opportunity through the chat to post your question, and chances are the questions you have are shared by pretty much everybody, because we discover that all of the issues in personal finance are pretty common. So I'll begin by just talking about where we are, and I think we all know the situation most acutely. We are in the midst of an unprecedented period in our history. The pandemic is creating all sorts of uncertainty. And, oh, by the way, we have an election coming up in about a month. So as if we had nothing else going on, we've got natural disasters left and right, hurricanes in the southeast and fires in the northwest. And it's really creating a lot of turmoil for an awful lot of folks. And it is creating a lot of pain throughout the country. We've had 50 million people lose their jobs. We have unemployment at the highest level since 2008. The Congressional Budget Office projects that it's going to take 10 years for many of the Americans who've lost their jobs to be able to find new ones, which means 2030 before a lot of people are back to work. This is kind of similar to what happens in every recession. It occurred back in 2008 as well. It took 10 years for people who lost their jobs in the 2008 crisis to find new work. The same thing happened in the 1992 recession. It took 10 years for people to recover. The same thing in the 1970s recession. So this kind of situation is, I will call it normal, expected, but that doesn't mean it's pleasant or easy. And it's creating a lot of crisis for an awful lot of families across the U.S. Part of the real challenge is that 110 million American households went into this pandemic already in credit card debt. And 25% of those households have had to increase their credit card debt because of the reduction in income and increased expenses due to their family circumstances. We've seen huge impact on virtually every aspect of the American landscape: agribusiness, education, corporate and commercial real estate, residential real estate, housing, of course, healthcare. We have seen impacts that we are still not yet sure where it's all going to end. And we have an election that is extraordinarily close. The polls are varying in their degrees, but basically when you compare the popular vote to the projected electoral college vote, there's simply no certainty in the election today. Contrast that to 1972 when Richard Nixon defeated George McGovern. Everybody knew going into that campaign that Nixon was going to win. In fact, he won so handily that George McGovern wasn't even able to carry his own home state. Nixon won 49 of the 50 states. This is not that. We don't know who's going to win, and we have the added challenge of the president struggling with the coronavirus now himself. We wish him and the First Lady a speedy recovery, but we don't know what this means for the campaign's final weeks. So all of this is uncertain. All this uncertainty is creating, in many cases, panic among many consumers. And a lot of folks are uncertain as to what to do, but anticipating actions. And I'm just going to give you two statistics that we have recently uncovered. We did our own survey at Edelman Financial Engines very recently, and what we discovered are two things. Number one, half of Americans are supporting one candidate or the other. That we see from all the data. There's no surprise there. But there are two other pieces of data that we have uncovered that we have not seen other pollsters providing. Number one, half of all Americans say that they plan to change their investment strategy as a result of who wins the election. And when we ask the question, do you think your favored candidate will win the election? Only 3% said no. 97% of Americans believe that their candidate is going to win. Even though half the country says Biden and half the country says Trump, 97% are pretty optimistic that they know who the winner is going to be. My concern there is that there's a lot of folks setting themselves up for optimism, and it may not be supported by the election results. And when people's optimism get dashed, the result can be fear and panic, when you already have half the country saying they're going to change their investment strategy as a result of the election, we could have a lot of folks throwing their personal finances into turmoil, changing a long-term investment strategy because of the short-term election results, none of which is in your best interest. So I cite all this for you to basically convey one simple message, and then we'll get to your questions. And the message is this: regardless of what happens in the election in a month, regardless of what happens in the presidency over the next 4 years, that will have a remarkably limited impact on your ability to achieve your long-term financial goals over the course of your life. If you're planning to retire in 20 or 30 years, if you have a life expectancy of 40 or 50 years, what happens in the next 4 years is going to be of remarkably little difference. Think back 20 years ago. Who was the president? You probably can't recall off the top of your head, and that's how you'll feel 20 years from now when you look back on 2020. 20 years from now, we're going to look back on all kinds of crises that our nation will go through. Our nation has bounced from crisis to crisis ever since we were founded over 200 years ago. So we need to put this election into proper context. It matters a great deal for the nation. There are all sorts of political and social issues that our country is facing, and they matter a huge amount. But don't allow those political and social issues to translate into your investment strategy, or you'll otherwise likely make a mistake. And I'm happy to elaborate on that if you like, or whatever you want to chat about. And so I'll leave it to you, Jessica, to coordinate the Q&A.
Excellent. We actually did have a question come in from Noah Garcia regarding the election. So at this point, I'm going to ask the team working behind the scenes to unmute Noah so that Noah can ask his question directly to Mr. Edelman.
Yes. Hi, nice to meet you. I was just wondering, with the election coming up, should we expect the market to move up, down, like anywhere in between? How does it typically react after an election?
You can expect, yes. Yes, it will move up. Yes, it will move down. You can expect volatility, extensive volatility. We have seen extraordinary volatility here in 2020 during the pandemic. In the first 6 weeks of the year, the market was up 5%. And then the pandemic hit and it fell 35%. And then everybody decided on Wall Street the pandemic was no longer a problem, and the market gained 60%. And in September, it fell another 6%. So we have seen massive amounts of volatility, and you can expect even more over the next several weeks. And depending on how the election sorts out, continued volatility, for the simple reason that the president has made it clear that if he does not win, he may well challenge the election results. Due to the incredible rise of absentee balloting because of people's COVID fears, nobody wants to go to the polls where they might get infected, we are going to have an unprecedented number of Americans voting by absentee ballot, and those ballots may take days or weeks to be counted, and in the meantime, they may be challenged. We already have 150 lawsuits filed in 42 states from both political parties about this election. So it is quite possible that we won't know who the winner of the election is on November 3rd. It may take weeks. It could theoretically take months. It's not the first time that our nation will have gone through this. The first time this happened, I mean, we all remember the Gore-Bush election where it took weeks for us to learn who the winner was. That wasn't the first time this happened. The first time was in 1800 when Thomas Jefferson was competing against Aaron Burr. The Electoral College was unable to choose a winner, and so the vote under the Constitution went to the House of Representatives. They spent 36 votes over a 2-month period before finally choosing Jefferson as the winner. And so you can imagine the turmoil in 1800, and that was in an era of slow communication. This time around, we have minute-by-minute live feeds of exactly what's happening. So you can expect investors to be concerned and speculative on the latest news over who it looks like is going to be the winner. And so, yes, you can expect a substantial amount of volatility, Noah, as we go forward in the next several weeks. And that even excludes the possibility of news about COVID, We are all expecting the three major pharmaceutical companies developing vaccines to issue announcements over the next month. They may say something that investors don't want to hear, or it could be exciting news that they would be thrilled to hear. We also have a president who has the virus, and the next 10 days are going to be very pivotal in the news of his prognosis. That could throw the election into further turmoil. So we don't know is the short answer. And Wall Street hates not knowing. So yes, expect volatility. Now, that doesn't mean that volatility is always bad. Volatility means prices go up and down. In other words, nobody objects to upside volatility. It's only downside volatility we get upset with. So recognize that volatility cuts both ways. And the markets may go up as much as they go down, even more so. We just simply don't know. The bottom line is this. We will eventually figure it all out. And by January 20, we will inaugurate our next president. And we will then have an idea of what those economic and tax and regulatory policies are going to be for the next 4 years. And we can make some more effective decisions at that point. I would not engage in portfolio management strategies today because we don't have enough information. And anything you do will sheerly be speculation. That's not investing, that's gambling.
Thank you.
Thank you.
Our next question is coming from Bridget Lempler. Bridget, the stage is yours.
Hi, I was wondering if you had any advice on new parents investing for their children's future education versus other options like your retirement or other, venues for your family.
Yeah, it's a great question. How old is your baby?
My due date is today.
Yeah, oh my goodness gracious. And well, I hope I don't cause contractions, but I do have a great name for your baby. So congratulations. That is extraordinarily exciting. I'm a little shocked that you're watching this while about to have a baby. It's wonderful that you're thinking about your baby's college education right now. That is absolutely fabulous. I wish every parent did that. In fact, what I often say is not only is it wonderful that you're doing this, knowing that your baby is like literally day one, but I always tease high school kids. I always ask them, do you think you'll ever have children one day? And they always say yes. And my response is, well, then why haven't you started saving for your baby's college yet? Because we all know the longer you give the money time to grow, the more it'll grow in value. So most parents don't start thinking about this till their kids are in high school and they only have a few years. You're being really smart. You've got 18 years, but you could have started 7 years ago, giving yourself 25 years to allow money to grow, but nobody ever follows that advice. So I won't even bother mentioning it. So what do? This is absolutely wonderful. I'm glad you're saving at such a young age for your baby. But here's the key. A common question I get is, I have limited amount of money, and I'm trying to figure out where best to save it. So if I have to choose, should I save for my baby's college, or should I save for my retirement? And most parents choose college. And the reason that they do that, two reasons actually. One, it's my baby. I'm going to do whatever it takes. And I'm going to self-sacrifice. I'm going to do whatever to protect and defend and nurture my baby. And if that means self-sacrificing my retirement, then so be it. I'm going to do what it takes to be a great parent. My parents did it for me. I'm going to do it for my baby, or vice versa. My parents didn't do it for me, so I am going to do it for my baby. Second, they say, my baby's college is going to come before my own retirement. So I need to pay attention to that first. And after I deal with college, then I can deal with my own retirement. So it's very common for parents to emphasize college funding before they focus on their own retirement funding. Huge mistake. You must focus first on your retirement savings. Only after you are properly saving enough money for retirement can you then take any extra money available and devote it to your kids' education. And there are a lot of reasons for this. Number one, your retirement is going to cost a huge amount more than college. And the only way you're going to have any hope of accumulating enough money for your retirement is to start saving immediately for it. You need as many years as possible. You can't wait until you're in your 40s or 50s. Ask anybody who's in their 50s and they'll tell you, I wish I'd started 20 years ago, right? Raise your hand if you're in your 50s and you've said that. Everybody says that. So listen to those 50-year-olds and do what they wish they had done, because you're much younger and you can do what they didn't. So you need to start saving immediately for your retirement, because it's a big number and a big effort. Number two, retirement is the only major expense you incur that must be pre-funded. You think about this. When you bought your house, you didn't pay cash. You have a mortgage. You're paying for the house while you're living in it. That's okay. Think about your car. You didn't pay cash. You're driving your car while you're paying for it. That's okay too. Think about college. You can pay for college during your career while you're using the degree that you got. And that's okay too. But you can't pay for retirement while you're in retirement. You have to pre-fund it. So for that reason alone, you have no choice but to emphasize your retirement over your child's college funding. Let me give you another reason. And Sandy will be very glad to hear this. By the time we get to college 18 years from now, it's probably going to be free. And this is due to, see, I told you Sandy would like it. This is due to exponential technologies. We have massive innovations in education tech, as well as so many other aspects. It's the source of my newest book, The Truth About Your Future. We're giving away a few signed copies today for you. The Truth About Your Future is a focus on exponential technologies, AI, robotics, big data, nanotech, biotech, bioinformatics, 3D printing, robotics, Bitcoin and the blockchain, fintech and edtech, and all of these technologies are doing unbelievable things. They're democratizing and demonetizing many of the costs we are familiar with at the moment. College is becoming free. It is already free in a great many ways around our country. 16 states already make 4-year educations free. More than 30 states make 2-year educations free at community college. We already have private companies, Starbucks, Disney, Jeep, Chrysler, Fiat, Walmart will all pay for your college degree. The Army, of course, does it as well. So why spend $200,000 on a degree when you can get the degree at little to no cost today? And 18 years from now, it'll become even more the norm for doing this. In other words, you might feel that you have to save a huge amount of money when in fact that amount of money isn't going to need to be saved at all. So focus first on your retirement. And once you have a financial advisor telling you that you are saving the proper amount of money for retirement in the proper places, and you then have extra money available, go ahead and put it into a college fund. And when you do that, use a 529 college savings plan. Do not use a tuition prepayment plan. Both are under the laws of 529, but you want the college savings plan, not the tuition prepayment plan. And a financial advisor can help you determine which 529 plan is best for you and how much money you ought to be saving in it. And congratulations again on your baby.
Congratulations, Bridget, and good luck today and the rest of the coming days. Our next question for Mr. Edelman comes from Alan. I think Zhao, I apologize if I'm butchering your last name, and your question particularly has to do with retirement, so I think it's a good question to follow up with Bridget. So at this point, Alan, if you could ask Mr. Edelman your question.
Yes, thank you, Mr. Edelman. My question is, I understand that people who have 20, 30, 50 years horizon can take all kinds of ups and downs. What about for someone who has, let's say, 5-year horizon or maybe even 10 before retirement? What are the some good ways to allocate their retirement portfolios?
So you are 5 to 10 years away from retirement, I'm gathering, yes?
Yes.
Okay. So yeah, you're raising a very important point, but there's a little bit of a tweak in it that I want to give you. when we look at the notion of investment management, and my firm's managing about 220 billion in assets now for 1.2 million households across the country. We're the largest investment advisor in the nation. We discover that people understand the basic premise, but they make one fundamental mistake. So the basic premise is all about risk. We know that investing is as much about risk as it is return. Many people get that point wrong, and they think that it's just about return. How much money can I make from this investment? Should I buy that stock? How do I double my money? And so on. And that's a mistake, because we have to recognize that the higher the return, the higher the risk. Now, when you're young, and this is Alan's point, when you're young, you can take the attitude, I can handle a lot of risk, because even if I lose a lot of money in 2020 due to COVID, so what? I've got 40 years until I'm 65. By then, this will be old history. Think about the crash of 87, right? That was 35 years ago. So what? It has no impact today. And whether you invested the day before the crash or the day after the crash, today you're in great shape. So time solves a lot of problems with investing. And therefore, Alan's right. When you're young, you can afford to take a lot of risk. And that means you can choose stocks and stock mutual funds and stock ETFs, because even though they're risky, over very long periods, history shows that they're the most profitable. Works out fine. But then you get to being close to retirement, like Alan. You're within 5 years or maybe 10 years, and you begin to say to yourself, I can't afford to lose half my money in a market crash like 2008. Imagine if you were 62 in 2008 when the market fell 57%. All of a sudden, your hopes of retiring in a year or two are gone. And that's what happened to millions of people in 08. So folks today say, if I'm close to my goal of retirement, I better pull back on the risk. I better reduce how much of my money I have in stocks. And that makes perfect sense. So we call this a glide path. At age 20, 100% of your money in stocks, like an airplane at 40,000 feet. And as you age and you get closer to retirement, as you approach, you reduce the amount of money you have in stocks. So that by the time you're at retirement, instead of having all of your money in stocks, you only have a smaller part in stocks. Does that make sense? This glide path matters a lot. But people often get the glide path wrong. And this is, Alan, what I want to caution you about. Because you phrased your question the way most people phrase it. How much of my money should I have at risk as I near retirement? And here's the issue. Your retirement is not the right point that you should be thinking of. The fact that you're going to retire in 5 years or 10 years doesn't matter. Retirement is not a material date in your financial plan. What matters is your life expectancy. So retiring in 2 years is one thing, but living for 30 is something totally different. And what we discover is that people build a glide path to take them to retirement. What I want you to do is to build a glide path through retirement, all the way to your life expectancy. So that makes a big difference, because if you use a 5-year time horizon, you're going to have very little of your money in stocks. But if you have a 35-year time horizon, you'll still have a lot of your money in stocks at age 65. And that makes a huge difference, because during your retirement, you're going to be dealing with inflation, the increased cost of living, and you're going to need money in stocks to help you offset that so that you're not poor at 85. And based on my book, The Truth About Your Future, you'll discover that your life expectancy is probably going to be 100, 110, maybe 120. Your glide path has to allow your money to last a very long time, not merely the next 5 years or so. So you're right, pay attention to your glide path, but make sure you're building the right one.
Mr. Edelman, if you don't mind, if I could just follow up with an additional question from the question we just answered. What does that mean for target date retirement funds?
We don't like them. We're the biggest advice provider to 401ks in the country. We serve about 140 of the Fortune 500, and like Boeing and Ford and IBM and AT&T and Delta and so on. And they all have target date funds in their retirement accounts. They're the most popular fund of 401ks. We're not big fans. And the reason we don't like them, well, there are two reasons. The number one is the glide path. A lot of target date funds, this is a mutual fund you buy that has a target date. You buy a 2020 fund or a 2030, 2040, or 2050 fund. And by picking the date, say 2050, it builds a glide path for that date of 2050. So you don't have to worry about how to do it yourself. You just put your money in the fund and they do it for you. It sounds great. It sounds easy and convenient. The problem is that a lot of those funds build a glide path to retirement instead of through retirement. So if you're going to use a target date fund, you need to make sure what its glide path really is. That's why we don't like them a whole lot. The other reason I don't like them is that because as a financial planner, they really annoy me. And they annoy me for one reason. Imagine this. Imagine you choose to hire me or my firm, and you come in to meet with us, and you bring all of your financial information, and you have your 2 pages of questions, and you and your spouse have been giving this a lot of thought, and you sit down with us, and I look at you and I say, glad to see you here. Do me a favor. Tell me the age at which you plan to retire within a 10-year period. Is it 2020, 2030, 2040, or 2050? And you say, well, it's 2040. And I say, great, here's the portfolio for you. One question: what about your income, your expenses, your assets, your debts? What about your goals and objectives? What about your attitude toward risk? What about family circumstances? What about caring for children or aging parents? What about charity and community? All of a sudden, the target date fund builds you a portfolio on one single data point. If I tried to do that, I'd be thrown out of this business for negligence. But a target date fund just says, oh, you're going to retire in this year? Great, we're going to give you a strategy. It's ridiculous. It's so simplistic that it can't possibly meet the effective needs of the people who are buying those products.
Thank you. Our next question is from Dan Drutz. Dan, you have a question for Mr. Edelman about student loans.
Hey, Rick. I hope you and Jean are doing well. Thanks for doing this today. We appreciate it.
Sure.
So with student loans, somebody that's, say, not right out of school, but has been out of school for a while, kind of always paid the minimum because the salaries they had weren't really high enough to pay off their student loans in 10 years like they want you to do. Where is that in, your strategy for paying down debt? Is it the least important thing to worry about? Most important? How important, or how would you help somebody to try to pay off their student loans to get that off of their debt?
Yeah. So let me give you the 4-step process of wealth creation, because that's the point, right? This whole thing is all about creating wealth, right? It's not about becoming debt free. It's not about paying off debt. Let's not take our eye off the ball. The goal here is to create wealth. So let me show you how to do that. Step number 1. Join your retirement plan at work. So if they offer you a 401k, 403b, 457, I don't care what kind of plan it is. I don't care if it's a good plan or a bad plan, join it. And contribute the maximum you can on a pre-tax basis. That's step number 1. Do that before anything else. And people are sometimes shocked because I set that as number 1, as opposed to paying off debt is number 1. And there's somebody else who talks about money a lot on TV and has written a bunch of books. And she's a big-haired blonde. I'm not going to mention her name, Susie Orman, because she's an idiot. And she says pay off debt first, and she's dead wrong. Because if you wait to pay off your debts before you start saving for retirement, you will never start saving for retirement. You are always going to be in debt. always, between cars and mortgages and college, let alone medical bills or other stuff that comes up in life, you're always going to be in debt. In fact, one of the other survey questions we did, I asked, did you borrow money due to the pandemic? And 50% of Americans said yes, that they've had to go into debt because of the pandemic. And then I asked the question, why? What bill did you incur? What forced you to go into debt? You know what the number one answer was? To help family and friends. In other words, people were going into debt not because they needed the money, but because members of their family did. So you're going to incur debts your whole life, whether you like it or not, especially if you get married, because it's your stupid brother-in-law who's going to need the money. So you can't avoid it. So step number one is save for retirement no matter what. Step number two is pay off the debts. And now we want to prioritize them. If you have a mortgage debt, great. You should, in fact, have a big, long mortgage. I love big 30-year mortgages, especially now with interest rates below 3%. Make the regular monthly payment, 30-year loan, not a 15, no biweekly payments, no extra payments, just make your regular monthly mortgage payment. Same thing for car loans, make your regular monthly payment on the car. Ideally, you'll have a 48-month loan or less, not a 72-month, but a lot of people are doing that now. That's a bad idea. Pay your car loan monthly, on schedule. Student loans, pay them the minimum, fine, no problem. Let it take 20 years to pay off, I don't care. Credit cards, you want to get rid of fast because they are much higher interest rate debt. And in my book, The Truth About Money, I have a complete outline of how to get rid of that debt. I won't go into that detail here, but it's only the credit card debt and expensive debts that you want to get rid of fast. But student loans, car loans, mortgage loans, make the minimum payment, make it on time for the 5, 10, or 20 or 30 years it takes to get rid of it so that it doesn't interfere in your ability to do number one, which is to save for retirement. After you get rid of the credit card debt, step number three is to build cash reserves, a rainy day fund. So that if you have an unexpected bill, the roof leaks, your child breaks an arm, you lose your job due to the pandemic, who knows what, you've got cash available to you to get through the crisis. We're telling our clients 3 years, 2 to 3 years worth of spending in cash reserves. We used to say 3 to 12 months. We now say 24 months because when you lose your job, it could be years before you get another one. And then step number four, after you have the cash reserves, now you're ready to start saving and investing in a diversified portfolio after all the rest. So retirement plan, pay off credit cards, cash reserves, and invest. That's your 4-step process.
Mr. Edelman, can you speak a little bit more to your philosophy on home mortgages, especially now with the market being so hot?
Well, it's not merely a question of especially now. It just makes it even more attractive. I kind of created a bit of a controversy 30 years ago when I announced on my radio show that I felt you should get a big, long mortgage and never pay it off. And this was heresy when I first said it because everybody always said that owning a home is the American dream and owning it outright is key. And you might want to ask your parents or grandparents about something that used to be called a mortgage burning party. And I remember when my grandparents had theirs and when my parents had theirs. You'd make that final 30-year payment and they take the mortgage and they literally burn it in a trash can in the front yard. And it's a huge celebration. They own their home outright. And it used to be a rite of passage. And that notion of owning your home outright came out of the 1930s. Because in the Great Depression, millions of Americans lost their homes. But today, people fail to understand why that happened. It wasn't that people lost their jobs that caused them to lose their home. Back then, banks were allowed to demand full repayment of the loan at any time upon notice. So when the banks suffered the run in 1929, the banks ran out of cash, and they sent messengers carrying Western Union telegrams to homeowners across the country saying, "We're calling your loan due." Well, nobody had the money. That's why they had the loan in the first place. So the loan was called. They couldn't pay. They got evicted. and millions of Americans ended up homeless in the Depression. That resulted in new legislation, and it is now illegal. Banks can't do that anymore. The only thing a bank can require is that you make this month's mortgage payment. That's it. And as long as you make the payment, that's all they can ask for until next month when they get to ask for the next payment. So you don't run the risk of losing your house suddenly and surprisingly. So the mortgages today are not nearly as risky as they used to be. And so I started talking about how mortgages are actually an excellent financial tool that helps you build wealth. They're not a debt. It's not like a credit card. And I ended up creating 11 great reasons for carrying a big, long mortgage. You can get the full 11 reasons in my book, The Truth About Money. I did a survey for my third book, Ordinary People, Extraordinary Wealth. We interviewed 5,000 affluent Americans across the country and asked them basically, how'd you do it? How'd you become rich? What are the behaviors you engaged in? And in doing this very elaborate survey research, we discovered that these 5,000 people from all walks of life, all across the US, all ages, all occupations, marital statuses, education levels, etc., they were all doing 8 things in common. And number one is that they all have a mortgage. Even though all of them could afford to pay it off, they all realized that having a mortgage helped them build wealth. So I've got 11 reasons all told. A short, easy one is that today's interest rates are very low, about 3%. The stock market averages 10% a year over long periods. So I would love to borrow money at 3% for 30 years, invest it, and earn more than that. What a great arbitrage. And I have liquidity the whole time. The problem with paying off a house is that it doesn't help you buy food. It doesn't help you buy medicine or clothes or pay other expenses. So even though you might not have a house payment, you still have all your other bills to pay. So every time you give money to a lender, that's $1 you'll never see again until you sell the house. And there are a lot of people house rich and cash poor, and that doesn't serve them well at all. So like I said, I've got 11 great reasons. I have a full 90-minute seminar on just this one subject because it's a huge issue. Most Americans are doing it wrong and to their disservice. So yeah, don't be afraid of a mortgage. It's your friend.
We have a couple of questions coming in from our young alums and students about where to start. So at this point, I'm going to hand it over to Kyle Perez. Kyle, if you could ask Mr. Edelman the question that you submitted.
Sure. Yeah. Thank you, Rick. It's really great to see you here, and thank you for your time. My name is Kyle Perez. I'm a senior graduating from Rowan with a finance degree, and then I'll be going directly to work in the insurance industry. And my question is, what advice do you have for new alums or soon-to-be alums that haven't really set any long-term financial goals, and what kind of process we should go around that?
Set them. You're graduating in May?
Yes.
So they're going to stamp adult on your forehead, and you've got to start acting like it. You've got to start thinking like an adult and thinking about the adult responsibilities. Party's over, Kyle, so you've got 6 months to have fun, and then it's the cold, cruel world that they're going to throw you out into. So you need to start thinking about your future and all of the elements in it. Might you ever get married? Might you ever have children? Might you want to buy a house, buy a car? Might you ever one day want to start a business? Might you want to support philanthropy or charities and community groups? Might you want to quit work and go sail around the world or traipse across Europe? Might you want to get to a point where you don't have to earn income in order to have income? You need to ask yourself your questions of where do you see yourself in the future? Once you know, now you can set specific tangible goals. That's what my second book is all about, called Discover the Wealth Within You, which is designing how do I get from here to there? Because once you know what it is you want to do, for example, I want to buy a house in 5 years. Great. How much is the house going to cost? Now we know how much of a down payment we're going to need. And now we know how much money we need to save on a monthly basis to get from here to enough for the down payment. And you do that for every goal. And then you add it all up, put it all together in a comprehensive package, and you now have a full-blown financial plan. And that plan is an ongoing process. It is not a one-time product because it evolves over time. As you get older, your circumstances change, your attitude changes. And so you begin to modify the plan based on new information. And the plan is constantly evolving and revising to stay current with your current situation and attitude and goals. And it's a lifelong process. But by having this focus, you can avoid making small little mistakes that would otherwise get in the way of your achieving your goal. When Jean and I started out, we gave ourselves a rule that neither one of us was allowed to spend more than $25 without the permission of the other. We're still observing that rule, although Jean told me a couple of weeks ago she wasn't. And so the reason is every time we wanted to buy something, we would look at each other and say, is this part of our financial plan? Because a lot of folks think that in order to achieve their goals, it's the big decisions that matter, such as what job to take, how much money to spend on a house, or how expensive a car to buy. And yeah, those decisions matter, but those are not the only decisions that matter. I'll give you one of my favorite examples, smoking. A lot of people consider smoking a public health issue. And although that's true, in my view, it's a public wealth issue. Most people who smoke a pack a day. And most who smoke started when they were 15. Well, if you smoke a pack a day from age 15 to age 70, with the average cost of $5.50 per pack, that's $5 million you won't have at retirement. If you drink 1 6-pack of beer a week, starting at age 21, 1 6-pack a week is $400,000 you won't have at retirement. So the next time you're thinking of buying a candy bar or a soda or a newspaper or a movie ticket, and you're saying to yourself, what's the big deal? It's only a few bucks. It's the little money. It's the daily spending that is the reason you're not able to achieve the big goals. So when you have a financial plan, you're able to put all of this into proper context, and you're able to say, is this helping me achieve my bigger goals? And you begin to realize what matters more, HBO or my kid's college fund? What matters more, this Snickers bar or my retirement security? So think about where you're going. You know, as Yogi Berra said, if you don't know where you're going, you'll end up somewhere else.
Great. Thank you, Mr. Edelman, and thank you, Kyle. The next question is from Janet Zansky, I believe. Janet, we're going to unmute you if you can ask your question. Right.
Sure. Hi. Thank you so much, Mr. Edelman. I appreciate the time that you're spending with all of the alumni here. I graduated, I think we may have crossed paths quite literally during the 80s. I was a student at Rowan, then it was Glassboro State College, but Rowan, let me see, from 1978 until 1982, I graduated with a BA in economics and went on to earn a master's and a PhD in economics. I'm currently a professor of economics. So it is a pleasure to talk to you. It's always a pleasure to listen to you on Saturdays too. So in listening to you, it's my understanding that you're not too hot on muni bonds. Did I interpret that correctly? Yeah, okay. So I sit back and go, we all know, okay, that the governments, state, local, federal governments are all going to be raising taxes. They have to in order to deal with this pandemic. Right. So has your stance on muni bond funds changed?
Yes, it's gotten worse.
That's great.
I'm not a fan of munis, and the reason is because of the dire economic, financial condition of the state and local governments around the country. The allure of munis is that they pay tax-free interest. And people who are wealthy, who have high incomes and are paying high tax brackets, and the three highest states are New York, New Jersey, and California, they're very appealing. New Jersey's top bracket, because they just passed the millionaire's tax, as you know, in New Jersey. So the top bracket in New Jersey is over 10%. So on a tax equivalent yield, earning a tax-free rate is better than a taxable rate. And the bond is guaranteed by the state government or Gloucester County or Camden County or whatever. So why not buy a government guaranteed bond that pays a much higher yield than you can get in a U.S. Treasury or a bank CD? It's an allure sales pitch, and it's very effective. A lot of stockbrokers make a lot of money selling muni bonds to wealthy Americans on that sales pitch. I'm not a fan. And the reason is because of the status of the American budget these days. The American pension system is $5 trillion in the red. Most state and local pensions are severely underfunded. The average funding rate is around 70%. Many are worse, like Illinois and others. New Jersey is not doing well in that regard. All the states have a balanced budget obligation, or 49, but the 50th does it anyway. So in the state of New Jersey, for example, we have had a sharp reduction in tax revenue because of the pandemic. With so many people unemployed, when you're not making an income, you're not paying income tax, and New Jersey is suffering a 20% reduction in tax revenues. That's why they created the millionaire tax. It's why they just created the gas tax. Their gasoline tax revenues are down 30% this year because nobody's driving. You're all working from home. So they're not raising the money they needed to raise. So New Jersey just raised the gasoline tax 9.5 cents. It's going to it's now one of the most expensive gasoline taxes in the country. And when they don't have the revenue, the budget law requires them to lower their spending. So they have to cut expenses on education, housing, social services, medical services, Medicaid, etc. At the very moment in the pandemic we need these programs the most, the government is forced to cut the programs. We've had 1.5 million municipal workers nationwide laid off this year due to the pandemic because the states don't have the money. And it's going to get worse because the pandemic isn't over yet. So in the face of all of this, New Jersey just borrowed $4.5 billion to balance its budget. That's essentially a tax of $4,100 for every resident of New Jersey, including your new baby today. So congratulations, they now owe $4,100. So for all of these reasons, I am concerned about the state's abilities to honor their obligations. And let's remember that many of those obligations are not GO, they're not guaranteed, they are instead revenue bonds. And a lot of those revenue bonds are not generating the revenues that are necessary to pay the interest and principal. We already have a larger number of muni bond defaults this year than at any time since 2008. And it's only the beginning. And the people who are buying these bonds are cautious, conservative, older, income-oriented investors. What happens when the bond defaults and they're not getting the interest that they're promised or access to their principal? We could have a crisis facing the very group of people who can afford it the least. We also have to worry about credit ratings because we have virtually every bond, every muni bond in the country, except for utility bonds and housing affordability bonds. Every other muni bond in the country is being downgraded by Moody's. And we know that when the credit rating goes down, the market value goes down. So even if you wanted to sell the bond, it's not going to be able to be sold for as much as you paid for it in the first place. So we think it's a really big problem. And considering the modest amount of extra profit you earn, it's not worth the additional risk. So not a fan of muni bonds.
Thank you. Okay, the final question that we're going to get to this afternoon is from Ken Kapakowski. Ken, if you could hop on to ask Mr. Edelman your question.
Hello there, Rick. How are you? Just wanted to get your take on holding on to dividend-paying stocks, even though the value of the stock may be going down, but the dividend is still rather healthy.
So are you talking about individual stocks or stock funds?
No, individual stock.
Okay. I'm
I
not
have a decision to make in the next month.
got it. So I'm not a fan of buying individual stocks.
I inherited them.
Well, if you inherited cash, would you be talking about keeping the cash?
Oh, that would be spent already with my.
So the fact that you inherited
Right.
stocks is irrelevant. People anchor themselves. This is a common behavioral finance phenomenon. It's called anchoring bias. I inherited stock from my parents, or I inherited a house. So what? Sell it. Pretend it's cash. If you had inherited cash, would you have taken the cash and bought that stock? If the answer is no, then sell it and do something else. If you had inherited cash, would you have bought the house your parents left you? If not, then sell the house and move on. Don't be anchored by the asset that they left you as an inheritance. I'm not a fan of individual stocks because it's riskier. I'd rather own a basket of 1,000 stocks. We give our clients portfolios that have 7,000 stocks from around the world because there's safety in numbers. It's lower in risk. So I don't like the idea of individual stocks. And if you are going to buy individual stocks, I'm not a big fan of dividend-paying stocks because there's an assumption that the company is going to continue to pay the dividend. We've had a lot of companies cut their dividends this year because of COVID. Their profits are down. They can't afford the dividends. Well, if the dividend goes down, then the perceived value of the company goes down, of the stock goes down, because that's why investors were buying it. So I'm not a big fan of that as a particular strategy. Owning dividend stocks is fine as part of a broader stock portfolio, but I'd rather you focus on your personal goals. What are you trying to accomplish? How much risk do we need to take to achieve those goals? And then we can decide what kinds of investments are appropriate to help you get to where you want to go. It really has nothing to do with whether or not you ought to be buying a dividend stock or holding a dividend stock today. So I'd rather you focus on a broader financial planning perspective of your circumstances, because and that'll make the question of your stock melt away.
Mr. Edelman, any final remarks before we do end of the show housekeeping?
Your questions were awesome, very well thought through, and shows that you've got a good handle on your situation. I would simply say that in this unprecedented period of time of uncertainty, there's no reason for you to go it alone. I would encourage you to rely on a financial advisor to assist you, someone who is objective, serving as a fiduciary on a fee basis, not a commission product pushing salesman, which is what you find at brokerage firms and insurance companies, someone who can assist you to help in your best interest. And I would encourage you to seek out a financial advisor. There's a lot of good advisory firms throughout the Delaware Valley, in Philly and in South Jersey. We have an office in Cherry Hill, although nobody cares about offices anymore because everything's by Zoom. So avail yourself of the expertise and experience that professional advisors can provide you. I think it'll be well worth your efforts to achieve your long-term goals.
Thank you so much. On behalf of the Office of Alumni Engagement, the Division of University Advancement, and Rowan University, we cannot thank you enough for kicking off our Homecoming at Home Week with such a strong start. And we are so appreciative of your time and also everybody's time who hopped on today. We do have a few giveaways. As I mentioned earlier, we have the truth about your future. We have 4 people that are going to be going home with this. We'll send these out next week. So I'm going to just say the names. And then if you could find me in the chat, I'm Jessica Kennedy, the lowercase letters. If you could just send me your email address and I'll be in touch to coordinate. Our winners of this book are Janet Romano Schubert, Levon Williams, Philip Blackman, and Lori Lodice. There's a signed copy with your name on it. Again, Janet Romano Schubert, Levon Williams, Philip Blackman, and Lori Lodice. This book is yours. Just send me your information in the chat. And then we also have one of my personal favorites. I read to my son often, The Squirrel Manifesto, which is an amazing children's book about how to save. And our winners, we, of course, had to select Bridget Hempler because she has a baby coming very, very soon. And Matt's on out. I'm sorry we couldn't get to your question, but if Bridget and Matt, you could send me your information in the chat, we'll be sure to send these out. Also just want to thank Dean Tweedy for hopping on, and also TD Bank for making all of our homecoming events possible this year. we appreciate everybody's time today. Thank you so much. Happy homecoming. And thank you again, Mr. Edelman, for your time.
My pleasure. Be safe, everyone.
Thank you. Take care.
Thank you.
Thank you.
Thanks a lot,
Thank
Rick.
you.
Okay, this is Joy. You know I'm computer challenged. Get me out of here.
You got it, Joy. Chris is going to kick you right out of the room.
I got
you.
I got you, Joel.
See you. Oh, wait a minute. I think I see it. I got it.
Oh.